So hey guys, today we are going to talk about the stock market. Who are you, brother? I said, who are you? I am their host. I'm teaching them from last 3 videos. Which niche you are in? I am in the self-development and self-improvement niche. Oh, I am in the personal finance niche and it is my ground. So go out of this room. Wait, you will teach them personal finance and careers development? Yes, I will teach them. Okay, so can I go now? Yes, you can go. I will teach them here. You go for the self-improvement and other niche. Hey everyone, welcome back. Look, if you have spent more than 5 minutes on social media, you have probably seen the video someone in New York sitting in a sports car or an influencer in Mumbai claiming they made 50,000 rupees before breakfast just by trading some random stock. It make the high stakes casino where everyone is hitting the jackpot except you. But here is the honest truth. The stock market is not a casino, and if you treat it like one, you are going to lose your savings fast. In this video, we are stripping away all the hype. In exactly 10 minutes, we are going to cover the absolute basics using real examples from both Indian and US markets. We will talk about the psychology traps that ruin most beginners, what actually realistic returns look like in rupees and dollars, and literally superpower of just being patient. No heavy jargon, just a real human guide. Let's begin. What actually is a stock? Let's start at a square one. What are you actually doing when you buy a stock or a share? Imagine your friend Sarah opens a business. It's doing great and she wants to expand, but she needs cash to grow. She splits her business into 100 equal pieces called shares. If you buy one share, you literally own 1% of that business. You are a part owner. That is all the stock market is. It's just a giant digital marketplace where you buy a share of Apple in the US or a share of Tata or Reliance in India. You are buying a tiny microscopic piece of that actual company. If the company grows and make more money, your little piece becomes more valuable. If they struggle, your piece lost value. You make money in 2 ways. Number 1, capital gains. Buying a share of Reliance at 2500 rupees and watching it to go to 3000 rupees, or buying a share of Apple at $150 and it goes to $180. Number 2, dividends. When a company make a massive profit, decides to cut a check directly to you just for holding their stock. Part 2, reality check. What are actually returns? Now let's talk numbers, because this is where a lot of beginners get hurt by unrealistic expectations. If you think you are going to double your money every single year, let me gently pop that bubble right now. Yes, what do actually historical returns look like? In the US, investors look at S&P 500, a basket of 500 biggest American companies over the last several decades. It has delivered an average return of about 10% per annum. In India, we look at Nifty 50 or Sensex, which represents the powerhouse companies driven the Indian economy, top 50 companies of Nifty 50 and top 30 companies in Sensex. Because India is a developing, fast-growing economy, its historically averaging return is slightly higher, sitting around 12% to 13% per annum. Keep in mind, these are averages. It doesn't mean you get a clean 12% or 10% every year. Some year the market rockets up to 25% or 30%. Other year, like during a global recession or a market correction, it might drop to 15%. And in a crash, it can goes to 5 to 2% and loss also. But over the long haul, it averages out beauty. Compared to a traditional bank fixed deposit or a basic savings account that barely beats the inflation, your money is in loss if you even keep it in your bank account or in some low-cost FD. Yes, you cannot beat. Your money value decreases day by day if you keep it there only. But the stock market in past couple of years and successfully beat the inflation, and it is really a massive think that you can understand the power of stock market. Which brings us to the most important part of this video. You can understand all the math in the world, but if you don't master your own psychology, you will lose money. Investing isn't a test of intelligence, it is a test of behavior. When your real money is on the line, you will face two incredible powerful emotions: FOMO, fear of missing out, and panic. Imagine you buy a stock. The next week, the US Federal Reserve's changes interest rates, or the Indian market reacts to some global news, and your portfolio drops by 10%. Your screen turns bright red, your stomach drops, you feel an overwhelming urge to sell everything to stop bleeding. That is panic, and it causes people to sell at absolute bottom, turning a temporary drop into a permanent loss. Conversely, when a hype train stock is rocketing up, FOMO makes people buy at the absolute top right before it crashes, and it is the biggest mistake that a person can do in the stock market. To survive the stock market, whether you are investing in Wall Street or the Lal Street, NSE or NYSE or Bombay Stock Exchange, you have to accept that the red days are completely normal, and it is a part of the process. Volatile is just the price of admission for the long-term wealth. Part 4. The superpower of patience. Compound interest. The power of compounding. Let me show you the little magic that happens when you mix those average returns with extreme patience. It's called compound interest. I called it the power of compounding. Let's look at two friends, both 20 years old, who decide to invest just a little bit of money every single month until they turn 60. US investor, $200 a month. Average return is 10%, and total out of the pocket is 96,000 when they turn 60. And in India, Indian investor, 5,000 rupees SIP, 12%, and on an average return 24 lakhs when they turn 60. Can you literally imagine? Look at those final numbers. The US investor ends up with over $1.2 million. The Indian investor, thanks to the slightly higher 12% growth rate on a 5,000 rupees SIP, ends up with over 5.9 crores. Yes, they invest only 24 lakhs and $96,000, but they came up with $1.2 million and 5.9 crores that can literally manage their whole life after retirement. In the first 10 years, the growth feels incredibly slow. You might look like nothing is happening, but the patience is a superpower. The stock market is essentially a mechanism for transferring wealth from the impatient to the patient one. Okay, starting out doesn't require a master's degree in finance or millions in the banks. It requires a shift in mindset. The action is required from your side. Treat it like buying a piece of real business. Accept realistic returns. Keep your emotions in check when the market gets rocky, and let time do the heavy lift. If you found this honest breakdown helpful, do me a hug favor. Hit that like button, subscribe for more real financial content, and drop a comment below. Are you investing in the Indian market or the US market, or both? Until next time, stay patient, stay smart, happy investing. And if you want a video on mutual fund, I'm going to make it after this one only. I'm working in it only for you guys. So please hit the subscribe and like. Support is needed from your side. Peace out. Happy investing.